How much you will pay in taxes on an individual retirement account (IRA) withdrawal depends on the type of IRA, your age, and the purpose of the withdrawal. Sometimes the answer is 0, you owe no taxes. In other cases, you owe income tax on the money you withdraw and sometimes an additional penalty if you withdraw funds before age 59 and a half. On the other hand, after a certain age, you may be required to withdraw money and pay taxes on it. There are a number of IRA options and a variety of places to open these accounts, but the Roth IRA and the traditional IRA are by far the most widely held types. The withdrawal rules for other types of IRAs are similar to the traditional IRA, with some minor unique differences. Other types of IRAs are the SEP-IRA, Simple IRA, or SARSEP-IRA. Each has different rules about who can open one. Key takeaways: only Roth IRAs offer tax-free withdrawals. If you withdraw money before age 59 and a half, you will be assessed a 10% penalty in addition to regular income tax, unless you fit one of the tax exceptions or are withdrawing Roth contributions, not earnings. At age 72, you are required to withdraw money from every type of IRA but a Roth, whether you need it or not, and pay income taxes on it. Tax-free withdrawals: Roth IRAs only. When you invest using a Roth IRA, you deposit the money after it has already been taxed. When you withdraw the money in retirement, you pay no tax on the money you withdraw or on any gains your investments earned, a significant benefit. To take advantage of this tax-free withdrawal, the money must have been deposited in the IRA and held for at least 5 years, and you must be at least 59 and a half years old. The other term for an IRA withdrawal is distribution. Point 1. If you need the money before that time, you can take out your contributions with no tax penalty so long as you don't touch any of the investment gains. Keep a careful log of the money withdrawn prior to age 59 and a half, and tell the trustee to use only contributions if you're withdrawing funds early. If you do not do this, you could be charged the same early withdrawal penalties charged for taking money out of a traditional IRA. For a retired investor who has a 401k, a little-known technique can allow for a no-strings-attached withdrawal of a Roth IRA at age 55 without the 10% penalty, says James B. Twining, founder and CEO of Financial Plan Inc., in Bellingham, Wash. The Roth IRA is reverse-rolled into the 401k and then withdrawn under the age 55 exception. Knowing you can withdraw money penalty-free might give you the confidence to invest more in a Roth than you'd otherwise feel comfortable doing. If you really want to have enough for retirement, it is of course best to avoid withdrawing money early so that it can continue to grow in your account tax-free. When IRA withdrawals are taxed, money deposited in a traditional IRA is treated differently from money in a Roth. This is because you deposit pre-tax income. Each dollar you deposit reduces your taxable income by that amount. When you withdraw the money, both the initial investment and the gains it earned are taxed at your income tax rate in the year you withdraw it. However, if you withdraw money before you reach age 59 and a half, you will be assessed a 10% penalty in addition to regular income tax based on your tax bracket. Point 1. There are some exceptions to this penalty. See below. If you accidentally withdraw investment earnings rather than only contributions from a Roth IRA before you are 59 and a half, you can also owe a 10% penalty. It is crucial to keep careful records. Ways to avoid the early withdrawal tax penalty: there are some hardship exceptions to penalty charges for withdrawing money from a traditional IRA or the investment earnings portion of a Roth IRA before you reach age 59 and a half. Common exceptions for you or your estate include: 1. Required distribution as part of a domestic relations order, in a divorce, qualified education expenses, qualified first-time home purchase, disability of the IRA owner, death of the IRA owner, and Internal Revenue Service levy on the plan, unreimbursed medical expenses, a call to duty of a military reservist. One other way to escape the tax penalty: if you make an IRA deposit and change your mind by the extended due date of that year's tax return, you can withdraw it without owing the penalty. Of course, that cash will then be added to the year's taxable income. The other time you risk a tax penalty for early withdrawal is when you roll over the money from one IRA into another qualified IRA. The safest way to accomplish this is to work with your IRA trustee to arrange a trustee-to-trustee transfer, also called a direct transfer. If you make a mistake trying to roll over the money without the help of a trustee, you could end up owing taxes. Most plans allow you to put the name, address, and account number of the receiving institution on their rollover forms. That way, you never have to touch the money or run the risk of paying taxes on an accidental early distribution, says Christy Sullivan, Certified Financial Planner of Sullivan Financial Planning LLC in Denver. In terms of IRA rollovers, you can only do one per year where you physically remove money from an IRA, receive the proceeds, and then within 60 days place the money into another IRA. If you do a second, it is fully taxable, says Maurice Armstrong, a registered investment advisor with Armstrong Financial Strategies in Cheshire, Conn. You should not mix Roth IRA funds with the other types of IRAs. If you do, the Roth IRA funds will become taxable. Some states also levy early withdrawal penalties. Regular income tax only once you reach age 59 and a half, you can withdraw money without a 10% penalty from any type of IRA. If it is a Roth IRA and you've had a Roth for 5 years or more, you won't owe any income tax. If it's not, you will. Money deposited in a traditional IRA is treated differently from money in a Roth. If the money is deposited in a traditional IRA, SEP-IRA, Simple IRA, or SARSEP-IRA, you will owe taxes at your current tax rate on the amount you withdraw. For example, if you are in the 22% tax bracket, your withdrawal will be taxed at 22%. You won't owe any income tax as long as you leave your money in a non-Roth IRA until you reach another key age milestone. Once you reach age 72, following passage of the Setting Every Community Up for Retirement Enhancement, or SECURE, Act in December 2019, you will be required to take a distribution from a traditional IRA. The IRS has specific rules about how much you must withdraw each year. The required minimum distribution (RMD). Point 1 If you fail to withdraw the required amount, you could be charged a 50% tax on the amount not distributed as required. There are no RMD requirements for your Roth IRA, but if money remains after your death, your beneficiaries may have to pay taxes. There are several different ways your beneficiaries can withdraw the funds, and they should seek advice from a financial advisor or the Roth trustee. The bottom line: the money you deposit in an IRA should be money you plan to set aside for retirement, but sometimes unexpected circumstances get in the way. If you are considering withdrawing money prior to retirement, learn the rules regarding a penalty and try to avoid that extra 10% payment to the IRS. If you think you may need emergency funds before retirement, try to use a Roth IRA for those funds rather than a traditional IRA. Please like, share, and subscribe to our channel.